Good afternoon, everyone. Hope everyone's doing well. Just want to do a quick sound check. Can everyone hear me? Just a thumbs up. Sounds all good. Everyone can hear me. Awesome, awesome, awesome. I've got a few more people in the waiting room. Just want to accept them, and then we'll jump on. Thank you again for everyone that's joining us on a Sunday evening. Hope everyone had a blessed weekend, an awesome week. We had a bit of a slow week last week, but price action was a bit iffy. I didn't really like it a lot. I didn't really see good A plus setups. Plus, when we managed to get into a trade, perfect entry, we just got taken out on break even, and then the move goes. So I don't force trades, and that's hopefully what I can teach you guys is to never force it. Never sit there and be like, I have to, because that is when things go wrong. That is when you try and look for something that's not really there. If you enter a trade, you get taken out, don't immediately just enter again. Just hang on. Just wait a few minutes. Check the setup out. Make sure what the actual intended target is has then been taken before re-entering the trade. So try not, I remember back in my days where where I took most of my losses and got hurt the most was revenge trading. That entering a trade, get taken out, then no, I know I have to be right, and then go back in, and then get taken out, and then go back in, and then you enter and pop, you in drawdown. Then you don't want to close it because you're in the red. Now you don't want to lose money where you could have gotten out and walked away at a break even. So the point that I'm trying to make is don't force your trades. If it's not there, it's not there. If it's the setup is not really good, it's not good. There's always another day. The market's going nowhere. I promise you, since I've been more patient and wait for decent quality setups, you get those aha moments where you're like, this is the one. Here we go. And we take it. And those are usually the ones that I get my best bet returns from. So I don't mind missing a trade. I'd rather make a little bit than make a loss, and I'll rather keep money in my account than give it back to the market. So unnecessary losses, I don't do it. All right, guys, we're going to jump into, I think I did the poll, and we had quite a lot of people. Hello, why does it? Yeah, it sounds like my sound's gone. Um, Sound still there? Can everyone still hear me? Okay, for some reason earphones. Okay, we still hear you. Okay. Sorry, donkey. Thanks for the feedback. Appreciate it. Okay. So I did a poll. 6-step, supply and demand, liquidity. And a lot of you want to understand liquidity and I'm glad, because that is the fundamental language that the market speaks when we are trying to read a chart. If you understand liquidity, you know where it's going, and you know when it's the right time to get into a trade and when it's not. So let's chat about liquidity a little bit, and then I am going to touch a little bit on 6-steps, and then we've got a little bit of a demand, or not a demand, but a request to talk about POIs. Now, POIs, if everyone that don't know, POIs is point of interest. So that is areas that we expect price to do something. It doesn't mean that it's the area that price will reverse from, but it's an area that we expect to see price react from. Now, POI can either be a reversal point or it can be inducement. So once we understand liquidity, you'll understand the difference between a reversal point and inducement. So let's quickly just dive into this. I want to just show you a general, we all understand a market trend. We have an up, correction, a push, correction, and a push. Okay, so this is the standard wave the market makes. It's a cycle. So an up, down, up is one cycle. So when we have a up, down, and an up move, that is one completed cycle that the market has has done. So think about a candle. Each candle, when it opens, it either pushes down and then pushes up, or it opens, it pushes up, and then pushes down. So that is a cycle that it completes. And in order to complete the cycle, it will give you a candle. So that would be the candle body there. That would be a wick, and that will be a wick. And there's your candle body that's formed. So by understanding that we have a cycle, a up, down, up, we then learned in our previous session about ICC. Intent, correction, continuation. How did we use that? We first identify the intent. Where's the market going? We wait for the correction and we jump in on the continuation. That's how we enter the trade. But there's something a little bit deeper. Now, who paid attention to the video that I made on Friday regarding US session? And I clearly said, what is US session going to do on Friday? Show of hands, thumbs. Who listened to the video, who understood it, and who was waiting for it to happen? Did anyone take the sell on Friday? Thumbs up. Who took it? Who was in it? Okay, Johan, anyone? James, yes. More? Anyone? No, guys? Now, how did I know these lows are going to be targeted for US session? How did I know this? Because we understood liquidity. I said to you guys, the fact that price returned to this low, so it was initially, that was a low, that was a low. London session came, it took the low, it gave us that push up. We tried to get into this buy position. Why? Because we could clearly see liquidity. So I knew London session was going to take buy side liquidity and then target sell side US session. I knew this. I wanted to get us into this buy. Unfortunately, if we zoom in a little bit here, we could see we jumped into the trade after this low was taken here. That low got taken. We try to jump into this trade at about this level here. We got that push up and then it came down. No, I'm lying. I'm lying. I'm on a 15-minute time frame. No wonder I'm not seeing it. There we go. So we jumped into this trade over here. It then pushed, came down, took out liquidity again. And why did it do that? The fact that London session failed to take this low, and that's why I didn't get back into this trade. That's why I didn't say, guys, let's jump into the buy again, because the fact that we had one attempt, two attempt, three attempts, there was no guarantee that price would not just take that high and dump down and take this low out. So the only way I could really then get into a new trade was to make sure that our buy side liquidity gets taken first. This is accumulation, compression. What happens in accumulation? We have manipulation, distribution. So once these liquidity levels got taken and we get that first bullish candle close, that's where we jump into our buy position, targeting what? Buy side liquidity, buy side liquidity, buy side liquidity. Plus, we then had Asia resting above. Okay, so once we understand where our liquidity pools are, it is then easier to identify a target, which means we can then trade. Does everyone understand this model? Remember, price moves in a cycle. So let's look at that cycle again. Up, down, up. What does that mean? Can anyone explain what do they think this means? An up, down, up move. Can anyone raise a hand that can potentially tell me? Anyone have an idea? Okay, no. So we have liquidity resting there. And in the move up, we created liquidity resting internally. So price will then return for internal range liquidity and will then expand for external range liquidity. It will then do the same thing, return internal range liquidity, expand external range liquidity. So simple. If we understand price needs to take internal, then expand to external, now we already have an idea of, hang on, once it's taken the one side, we know that it could potentially then go the opposite direction. Make sense? Simple, right? Let's look at it. Internal range liquidity to external range liquidity. Why? There we go. There we go. There's my tool. We're pushing down. We're making lower lows. We can see aggressive sell-off in this range. Aggressive sell-off. Why does price return, take out liquidity, then sells off? Returns, sells off. And funny enough, all of this that it's leaving behind is then liquidity to take on the way up. So it's leaving traces of liquidity and liquidity pools behind to fuel its next move. So once you understand what it's doing when it's moving in one direction, you'll know what it's going to do when it heads in the opposite direction. So let's look at liquidity again. Very simple. So I want to use Friday as an example because the fact that you guys did not catch the sell-off concerns me, even though I clearly gave you guys the move. I said, this is what's going to happen. I told you where it was going to go. So let's have a look. That was liquidity that was left behind. That was liquidity that was left behind. And do you see, let me just actually do this. Let's get straight lines. Straight lines so that we can clearly see the levels. So if we go to all these lows, all of that was liquidity pools. All of that was liquidity pools. On the way up, do you see it takes liquidity, reacts, takes liquidity, reacts, takes liquidity, reacts, and then pushes up, sweeps liquidity, reacts. On the way down, what does it do? Creates liquidity, pushes up, internal range liquidity, pushes down. This is now a major liquidity pool here. Major liquidity pool. Everyone with me? When price pushed up and it swept this liquidity pool and immediately reacted from. So what I like to see is this. This is the first signs. That sells off, comes back, struggles to push through, aggressive push through, and immediate reacting from it. Why the aggressive push? Because early sellers, stop losses resting above. Liquidity, we wait for the liquidity to get taken, and then on the aggressive candle there, that is only where we look to get interested because our stop losses can now be placed above. So if you enter a trade too early, this is what happens. You always get taken out if you are too early. What does the market makers do? They build the trap, they then take it, and then the real move happens. I'm trying to teach you guys to be patient to get into the trade at this level. After that has happened, if you can spot the sweep, you will not become the sweep. There was multiple opportunities to get into this trade. Multiple. Okay, so again, one very simple method. There's our sell-off. There we broke structure, so there we got our confirmation. What I personally like to do, let me clear this. What I personally like to do is this candle that sweeps the liquidity, I draw a line at the low. If we candle close below that level, I know the move is real. The intent is there. We're going in an opposite direction. So I jump in on a candle close. I jump in there. Stop loss there. Target opposing side. Very simple. Why? My rules say I cannot enter a trade until liquidity has been taken. Was liquidity taken? Yes. Liquidity was swept. There we can see it. Do we have a change in state of delivery? Do we have a market structure shift? Yes, because we candle closed below that level. Everyone with me? On a smaller time frame, this would be a push, a pullback, a break of the low, whatever we want to call that. But I only trade 15-minute, 5-minute time frame. That's where I am. On a close below that candle, that is where I jump into this trade. Stop losses at the high. Such a small stop loss. If we do get taken off, if we are wrong, it's okay. Look at the risk to reward on this trade. 3.6 R trade to target these lows. I knew that this low was a target. I knew it. Why? Because this was inducement. Yes, if this thing does it again, I'm going to scream. This was inducement. Relative equal lows. All the buyers try to step in here. More buyers try to step in here. Stop losses resting all over here. London session chases liquidity. That's all they do. I took this trade all the way down to about there. All the way. Once it took that low out, that's when I was happy. That's when I jumped out. So this was a beautiful trade that you could have caught on Friday if you just followed this simple structure. Looked at that liquidity pool. But something interesting I also want to share with you guys. If we draw a box from Asia high to Asia low, you'll realize that it always returned to EQ. Do you see the center line that it prints for Asia session? That is called Asia EQ, equilibrium for opening range. This is the first hour of price when it opens, market opens, the first hour. This is EQ. Price will always return to EQ somewhere during the day. It's amazing that it happens, but it happens. So that's something quite interesting. It's not something I use. It's just interesting to know where that level is and always to understand that that is a strong level that price could potentially react from and reject from. Okay, so let's look at liquidity again. Price has done exactly the same thing. It's left liquidity. It's left liquidity. Why do I say this? Was this high taken before making a new low? No, it did not. Was any liquidity taken before making a new low? No, it was not. So this is valid liquidity pools. This, you can clearly see the high was taken, liquidity was taken before selling off. But the alt liquidity pool was not. So think about it this way. Trend lines. If we have a trend line, let's use a bearish trend line because we're in this bearish structure. If we have a bearish trend line, think about it this way. Just as an example. Now, everyone that sold at this level will either got taken out break even or they took profit will enter again at this level and most probably place stop losses there. Once the trade runs, they will move stop losses from this level to this level. Everyone with me? Once they bounce again and new traders hop in, they will move stop losses to this level. Now the accumulation of all of these stop losses now rests at this level and so forth. Now it moves there and there. So the liquidity pool keeps building, it becomes more and more and more and more money resting. Eventually, price will pop through, take it all out, and then continue the move further down. Why? Because of liquidity that now rests above the trend line. I love this because support and resistance. Sorry, guys, I just want to close this door. I love this type of liquidity because support and resistance traders, trend line traders, breakout traders, all of those guys are jumping in and they're placing their stop losses on the most obvious position that the market knows where to take it. I trade into liquidity. I spot the liquidity and I trade liquidity, and it's made me extremely successful. So if there's enough liquidity buildup, I'm interested to look for a trade. But we wait for the manipulation. We wait for all the traders to get trapped. Then we jump into the game. All right. So that's the basics of liquidity. But how do we read it? How do we understand if it's valid or not? So let's look. Something very simple that I want to show you guys is once a high or a low gets taken before structure is broken, meaning we have a high, high, low, high. Okay, so there's our first break. Beautiful. Which means traders would have jumped in here. Breakout traders would jump in here. We then have a low, another high. Great. We have stop losses resting there. We've got stop losses resting there. If the market sweeps a low and then creates another break of structure, this is where the magic happens, because this is now a valid supply or demand zone. Plus, it's our 6-step. This is our 6-step entry. For those that don't understand the 6-step, go watch my previous videos. You'll get it, you'll understand it, and you'll grasp it. But now we've left supply and demand zone behind. So what do we want price to do? Same thing. Induce, break structure, take that low, return, tap, and push. Another trade entry. Same zone. Same zone. Now let's look at that in action. Here we go. In action. Here you can see how many times did price react off of this level. So look at this. We came down, pushed up, down, react, and then we broke structure. So this is a really nice, strong level over there. We did the same thing, pushed up, came down. We did not sweep that liquidity there. We did not sweep that. We did not sweep that. Price returned, took that out. Did it give us a new high? No, not yet. Failed, tapped, and then pushed through. So now we've got this level. But remember, we still have these pools resting below. Structure broke. There's the inducement, exactly like we speak about. There's the inducement. Price broke structure there, returned, tapped off of that, broke structure there, and then immediately returned to tap into our zone. That's exactly what I was explaining right over here. The same thing. That is inducement. Do you know how many buyers try to buy off of this level? Try to buy off of this level instead of here. Many, 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 many. Plus, all of these guys that was in this trade, all of their stop losses was resting here. They were on break even. Stop losses resting there. Market just came, took liquidity, then accumulated. So it did what it needed to do. It chowed all of that. Yeah, so it's extremely funny for me that gold is not flying to the moon with all of this war and with all of this drama that's going on. But there's conflict. The dollar is strengthening substantially. There's a lot of trust from Americans within the economy. The economy is doing stronger. I don't think it's going to last long though. Once everyone can see that there's not really stability, I think gold's going to fly. We're going to hit all-time highs very, very, very soon again. But back to my story, same thing. We can see this over and over and over. Market was in a downtrend. There we had our structure shift. So there, liquidity was taken before breaking structure. So what does this level give us? A very strong demand zone. Okay, price broke up. Look at that, came down, came down. So this is our inducement. Pushed up, took it all out. Everyone started buying off of this zone. Price came back, tapped into the actual demand zone, then took off. Same thing. It left all of this liquidity behind. I think we were actually in this buy position, if I can remember correctly. Same story, guys. It just keeps doing it. Same story. Look at that. Liquidity taken before new structure was created. What did it leave behind for us? A demand zone. Price pushed up, it returned all the way into our demand zone and then reacted off. The problem with most retail traders is not correctly identifying their zones to trade from. Everyone is trying to trade from every single down close candle that they see on the chart. It's not. So POIs are important, but you have to identify them correctly. Previous session, we spoke about the different types of POIs. We have SND. So if I speak about SND, it's supply and demand. Is there anyone else in the comments that can give me another POI? Another POI. We spoke about it the last time. Eugene, so OR is probably order block, but an order block is very similar to supply and demand zone. So all the ICT traders uses order blocks, breaker blocks. There we go. Fair value gap, FEG. Yes. Next. I'm not a fan of order blocks or breaker blocks. Anyone else? RDR. What? Rally. There we go. So it's rally, base rally. RBR. Rally, base rally. So it's a base. Let's just call it a base because you get various types of bases. You get a rally base rally. You get a rally base drop. And then a drop base rally. Different ways around, but let's just call it a base. It's a base. It's technically still a demand or a supply candle, actually. Anything else? So we have the other nice one is a IFVG, inverse fair value gaps. Strange enough, the market, gold specifically, loves its inverse fair value gaps to retest them. Okay, anything else? Anyone? So we have SNDs, we've got fair value gaps, we've got base. I think this RBR, I'm just going to call it a base. And we've got IFAGs. These POIs are super, 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 super important. If you identify these correctly, you'll know exactly where price will react from. You'll know exactly where it's going to go and where your potential rejections would go. Sometimes exiting your trade is more important than entering your trade. Anyone on this planet, even a 2-year-old, can push a buy and a sell button. The trick and the magic comes when we exit our trade. Do we exit too soon? Do we exit too late? Do we hold when we were supposed to exit? That sort of things. So going break even on gold lately, gold is sweeping and returning to the zones multiple times. The market has definitely changed from last year, guys. 100% the style of trading, we constantly have to adapt. Last year, I could enter trade, I could place my TP stop loss, I can walk away and I know it's TP. I didn't have to worry about going break even because the market was clear, precise. It had intent. It was moving. Now we sweep that same zone 6 times and then only goes. So we have to be patient. It's insane. It's insane. The market is extremely volatile, especially on gold. So with that said, I am going to trade S&P 500 for everyone with Prime accounts. It's called US 500. So please load it to your charts. US 500. We've got clean moves there. I'll show you guys in a moment. Okay. So POIs, SNDs, fair value gaps, base, IFVGs. So let's look at a few examples and we can see this. So here we've got fair value gap tested. Market rejects off of it, returns, fills it, rejects off of it, and then inverses it. So this inverse fair value gap has also left a base. So the one creates the other. Same thing. Fair value gap. There was a fair value gap there, pushed, retested, and pushed through. By doing that, it's left a base for the next move. See that? Quite simple. The one creates the other. When you have these confluences that stack up, because now we've got a market structure shift, we've got a fair value gap with the base, we know when price returns, sweeps this liquidity, taps into our base, above our fair value gap, we've got two areas that it can react from. It can either react from the base or retest this fair value gap. Zone in a zone. Morris, if market opens a gap, do we also call it? Yes. When the market gaps and it opens up, it's not a fair value gap, it's a market gap. We call it a market gap. 90% of times the market will return to fill the gap. Why? Because it's seen as an imbalance. Price does not like to be unbalanced. A fair value gap is a imbalance. Price is not balanced. That's why we want wicks of candles to overlap and not have gaps in candles. That's why fair value gaps work. Why? Because the price at that area is imbalanced or unbalanced. Imbalanced, unbalanced, however you want to call it, potato, potato. Okay, very simple. Base, return, sweeps liquidity, taps into the base, and then takes off. When it takes off, it creates another fair value gap. Below that fair value gap is another base. Why? Rally. So if we drop time frame, you'll see this. Let's go 2 minutes. There we go. Rally, base, rally. Right? Price returns, taps into the base, then reacts through and gets that strong push to sweep all of this liquidity resting above. This is the trap. This is exactly what I tell you guys. Look at this. Equal lows. Equal lows. Price pushes through. When it pushes up, everyone is trying to sell this aggressive down close candle. Everyone is trying to sell off of that as a supply area. Sellers are then stepping in. The moment they see this aggressive down close candle, they're all jumping into this trade thinking it's going to go down. It then goes, aggressively pushes up and takes out all of this. That liquidity fuels aggressive moves into the market. Aggressive. They chow up all of this liquidity. And what will most of these traders do? Because they've got such a small stop loss entering a trade from this area, what will they most likely do when they see price return? They'll move stop losses to this level, or they'll move it to this level, or they'll move it to this level. Because we've all done it. So don't tell me it's not that way. We've all done it. We all see price comes and we're like, no, we're not going to be wrong. Just move my stop loss a little bit more up. And then it comes close, then we move it up a little bit more. Then it comes close and we go higher up. Then guess what? Murphy's fucking law, it will take you out and then it will go. Always. No matter where you move that stop loss, it's going to come take you out and then it's going to go. Why? Because retail places these stop losses at the most obvious places. The most obvious places. Why did you not place your stop loss above Asia highs? Because if it was above Asia high and we take Asia high, I would have, for instance, if price pushes up here and I'm trying to sell, I would be very cautious because I know for a fact this would be a huge target. Imagine a huge X painted on top of a building and you're looking down. You can't miss it. It's an obvious place for most traders to place a stop loss in this specific scenario, especially after seeing this aggressive sell-off. So stop putting stop losses at obvious places or wait for the obvious place to get taken, then place your stop loss. That's a simple solution. All right. So liquidity is covered. I hope you guys understand liquidity. Above highs, above lows, above equal highs, above specific levels. And what is specific levels? Sessions, guys. Sessions is huge liquidity levels. There is a shit ton of stop losses resting there. Above this, there's huge stop losses. Why? Because everyone that trades this session would place their stop losses in that specific area. When the next session starts, one session will hunt a previous session's liquidity. So before you come to the charts and before you enter the trade, identify your liquidity levels first. That's the first thing we do when we come to the chart. Where's our liquidity? Where could price potentially head? And then we wait till it gets taken. Then we look to enter the trade. Or if we are far from a target, then we could trade towards the target if we know that that's where it's heading. So that's 90% of the time how I identify my trades and execute my trades. But 6-tap, guys, if we go 15-minute time frame, the 6-tap is insane. It's an unlimited money printing machine if you just learn to use it correctly. Just in this leg alone, I can identify with my eyes multiple 6-taps. So let's look at this. Let's just start here. This would be a 1, push up, 2, push down. There's our break. So this is our 3. Their price returned, gave us a shallow tap. That's our 4. It pushed down, it gave us a new break of structure, right? Remember our wave, up, down, up. It then returns to sweep this internal range liquidity. It taps into where? This base, supply and demand level, and then sells off. Sweeps liquidity, internal range liquidity, taps into IFVG, then pushes up, sweeps internal range liquidity, then pushes where? Back to external range liquidity. Higher time frame, 6-tap. There. There's our break. Boom. There's our break. Hope you guys are seeing this. The pattern. So remember, 6-tap. We need 2 breaks of structures. 1, 2, 3. Shallow tap. We don't want a deep tap. We want a nice shallow tap. And then another break. Most important thing that needs to happen in a 6-tap is if we draw that line straight through, we want this to be nice and shallow. If it pushes too deep down, then we've created what? Equal lows, which will then mean price will definitely take them. So we don't want a deep tap. We want like a shallow tap with another break. Most important, it must break again after giving you a shallow tap. Now we know this is liquidity. We know retail is jumping in here. Break and retest traders jumped in. Multiple traders jumped in. We now want price to return. Take that. Tap into whatever POI we've left here. Fair value gap, IFVG, whatever it is. Get a reaction out of this level. That's where we jump in. Stop loss under the low and we trade towards this high over there. That's our trade. Long position. There. Stop loss. Target. 1 to 2, boys. 1 to 2. If you can get a 1 to 2 out of the trade, I will take it any day. It means I'm risking 50 to make 100. It means I can take 2 losses and I need 1 trade to be break even. If I take 5 trades, I win 3, I lose 2, I'm profitable. If I lose 3, win 2, still, I literally need to lose 4 trades in a row for me to actually be like, okay, I'm down. I'm losing money. There's no way I'm losing 4 trades in a row. It's not impossible, but then we need to reevaluate what are we doing wrong. Then there's something wrong. Okay, liquidity, 6 taps, POIs we've identified. It doesn't mean if a POI doesn't work, it doesn't mean it's wrong. There was a reaction, but it's not your zone that you're trading from. No POI will work if liquidity was not taken first. That's the important part. Meaning, let's look at a example. Where's an example? There we go. There's an example. Beautiful example here. We can see price left fair value gap for us behind over here. IFVG actually in that level. That's an IFVG because the down close candle left a fair value gap, the up close candle left a fair value gap. So we have a IFVG that was left there. Liquidity was created. Look at this. Price broke, it returned, and then pushed through. So our 6 tap, the model is there. Let's look at a lower time frame. See if we can just see this a little bit clearer. There we go. So let's look at this. Price pushed down, swept liquidity, pushed up, broke structure. Perfect. All of our rules of engagement has now taken place. Price then pushed down and then back up again, broke structure. Liquidity left behind. It then pushed up again, broke structure. Beautiful. We now have a bunch of buyers that stepped in with all these lows being liquidity for us to take. When price returns, sweeps all of this, taps into our fair value gap IFVG, creates more liquidity. Remember, our stop loss would be at this low. That's our protected low. So even if you enter the trade here, it just tapped into a deeper level, took out all these early buyers that were placing stop losses too tight, and then it goes. Where's our target? Right over there or there. So our trade, literally, let's say we did take it there, which is totally fine. Stop loss under those lows. We want to target at least a 1 to 2 trade. So if you want a better risk to reward, you just need a tighter trade. I always take the deepest level, not the top level. I would potentially wait and take a trade off of that level there. That level would be my entry. Stop loss still under this low, and that would be my trade. 1 to 2 are there. That would be my trade. Did it hit? Yes, it did. Come on, man. It did hit. There we go. But we understand liquidity. That's the important part. Um, so we've covered liquidity. We've covered a little bit of the six-step zones. We've covered POIs. Was there anything specific that you guys want me to maybe quickly touch on? I'll do another 10 minutes, then I've got to shoot. Anything. I just saw there was a message that came through. Sorry, guys. Let me have a look here. Oh, where do I get to this chat now? Does six step only work on 15-minute? No. Any time frame, any pair, anywhere, even 1 minute. 1 minute is very quick. So I would strongly recommend 15-minute, 5 minute. Don't go under 5 minute, please, guys. So Marius, any time frame, any pair, six step is it's the cheat code. It's the source, brother. It's the source. Yes, so let's do that. Current settings of my, so I use this one, algos session range. So if you want to search it under indicators, you can just search algos. This one, algos Asia sweep. That's what it's called by that Noam bench something. Algos Asia sweep. And I use these settings. We just need to adjust. This has changed. That is now 3:30. There we go. All of that's still fine. 3 a.m., 10 a.m., that's now 3:30. Okay, then one last thing I wanted to show you guys that you could potentially use. Rian posted in the group about the uh, volume order blocks. So this will really, really help you guys to find your zones. Volume order blocks gives you your strong POI. So it measures, look at this beautiful cell out of that volume order block. So it measures the amount of volume out of a specific area and it then gives it to you. So you can clearly see who's in control in this level, buyers or sellers. We go 10 minutes. So I normally flip between my 15 minutes and my 10 minutes. Most important on this, I normally like to go to about a 7 or a 6. I prefer the 7. And there we go. There's our zones. How beautiful is that? It actually gives you the volume order block on that base, rally. It shows you the volume above. And when you have a huge volume order block above liquidity, I would not use this bottom one. Why? Because look at this. We've got liquidity, liquidity. So most traders will try and sell off of here. They'll get taken out. They'll try and sell off of here. They'll get taken out. This would be the real McQuay to sell from. This is the cheat code that helps you visually very quickly identify it. So again, this is it. Price action volumetric order blocks by UAlgo. Swing length 7. I love 7. 7 between 6 and 7, perfect for me personally. So let's look at S&P 500. Guys, insane. I took this monster trade on Friday on the S&P and clean structure. So these were the trades that I was testing our trade model for the week. Took this beautiful buy, took another buy here. I almost got caught with my pants down because this was very, very quick. Took a sell here and I took another buy here. And again, same thing. That was our 6-step. I knew we had this volumetric order block here. So I took a trade into my liquidity pool all the way up into my volumetric order block. Little bit of a cheat code and it works really well. So Marius, look at this. There's our gap. Price return to fill the gap. It will always return to fill the gap. Let's see if there's another one. There we go. There's a gap from there to there. price will return to fill the gap. That's 50% of it filled. That means mitigated. Anything more than 50%, mitigated. Fair value gap, order block, anything, we want at least 50%. So when it taps into a order block like this and it just wicks into it, and it just wicks into it. If it did not fill at least 50%, we know it will come back a second time to fill that imbalance. Okay, any more questions? Quickly. Anything else? Marius, we are actually in process of setting up a way to trade on TradingView itself. So that would be very soon. I think middle next month, then we'll be able to trade on TradingView itself. I'm currently trading on TradingView and I'm testing it. So far everything looks good, spreads good, everything's cool. So we might introduce it into the community late this month, early next month. Right. Any other questions, guys? Okay. Hope you guys learned something and I hope these sessions are valuable. And that you're actually taking something from it because I don't mind sharing my knowledge. I love doing this. I love interacting. I love the community. I have fun because trading was extremely lonely when I just did it on my own. Sit in front of the computer, no one to talk to, nothing to do. So I love this. I love this interaction and engagement with you guys. So the more you guys talk, chat, send messages, I hope you're enjoying the community. And I really, really hope you're taking value from it. So have a blessed Sunday. And then I'll see you guys Monday morning. We're going to rock it. We're going to take some money from the markets. Go buy some steak. All right, boys. Have a blessed evening. See you all next time.